Hello, everybody. Luke Gromen. Hope you are well. It's great to see everybody again. I've got some new fun buttons here in the studio, so just trying a few of them out. So, as always, thank you for joining me. Thank you for submitting the questions. Very helpful, very thought-provoking. Really enjoy these interactions. So I'm going to jump right in. Maybe a relatively quick one tonight here. The first question is from Mickey. How deflationary, if at all, do you think the AI news of the last week is for 2025 and 2026? What impact do you think this will have, if any, on future rate changes in QE? I don't know that it's going to have any immediate impacts on rate changes or QE, at least not directly tied. And I think ultimately, how inflationary or deflationary depends on how fast AI hits jobs and wages. And then once that starts to happen, and you're starting to see some signs from some of the tech elites out there, we'll call them, Mark Andreessen. You've had Zuckerberg talk about some things that are occurring surprisingly rapidly, Sam Altman, etc. The next question is how long do we think policymakers will allow wage declines, job declines, or the pressure, the aggregate pressure from AI to drag on wages, etc., until those wages and job losses, efficiency gains, however you want to spin it, start to weigh on consumer loans and consumer delinquencies. And we're already starting to see at the low end some rising consumer delinquencies in certain areas, consumer loan delinquencies. And once AI makes enough progress, then in theory, the deflationary impulses will start to weigh not just on consumer loan delinquencies, but then by extension, the banking system. And so it's unclear to me how fast that daisy chain of events will be processed and will flow through the system. From there, it becomes a question of a yes or no question. I think it's fairly simple to answer, which is, will policymakers stand aside and let the deflation on wages and jobs cause a banking crisis via consumer loans, et cetera, or will they step in and act to effectively start preserving the banking system by growing their balance sheets? I think we all know the answer to that question. It's just a question of how long this process will take. And so ultimately, the pace of productivity from AI, to me, based on what we've seen in recent weeks, runs, if you asked me how I would have thought about it 3 weeks ago versus now, it seems like things are moving faster. And I already thought things were moving very fast. And it is very difficult for the human psyche, everybody, to factor in exponential movements. The human psyche, human mind is just simply not wired to be able to discount that well. And so ultimately, things appear to be moving faster, which means we're ultimately moving closer to a need for maybe some sort of brief deflationary issue, followed by aggressive balance sheet expansion, dollar liquidity injection, central bank money printing, whatever you want to call it. And so the AI news, as I sort of distill what's happened in the last several weeks, if I had to distill it down to one simple conclusion, it's getting more critical for investors to own at least a bit of gold and Bitcoin, which are neutral reserve assets that are nobody else's liability when you hold them out of the banking system in the case of gold, or in an independent vault, for example, or in the case of Bitcoin self-custody. I think gold and Bitcoin are the two best, cleanest AI plays, paradoxically, because ultimately the deflation that AI is going to bring in is going to force consumer loan defaults and then ultimately significant money printing, as central banks are really going to have no choice but to fully reserve consumer debt and maybe other forms of debt, in my view. So that's how I think about that. The next question is from O. Is Trump setting the stage for a potential return to a gold-based, or let's say gold-related, gold-involved monetary system by proposing to eliminate the income tax in favor of a tariff revenue model, as he talked about, noting it was great for the U.S. 1870 to 1913, thereby laying the groundwork for such a financial shift toward a trade settlement system settled presumably on net, at least, by gold. Great question. In my opinion, yes, that's exactly what he's doing. Very possibly. I've been surprised. I've started to run through some preliminary numbers about when you start talking about 20, 25% or more tariffs across the board, how big a chunk of a number that actually is. It's $4 trillion in imports we bring in every year. So 20% of that's $800 billion. Individual income tax receipts are $2.5 trillion out of our total $5 trillion in receipts, right? So in theory, you could cut receipts by, or cut income taxes for individuals by a third, raise tariffs by 20%, and come out about even. Again, that's a very, very rough model, but it gives you a sense of what is possible. And so I do think he appears to be at least enamored with that type of a more tariff-financed, net gold settled model. So let's see how that works out. But it does appear to me a shift in that direction. From CV, short end yields staying put while 10-year plus yields rising due to inflation concerns. Mortgages are based on the 10-year, not the short end. So if inflation is going to cause real estate to appreciate and inflation is going to raise mortgage rates, how am I ever going to afford a home? I think it's really important to understand the currency in which you're saving. Home prices over the past 10 years, and especially in the last 5 years, they've risen sharply despite the fact that rates have risen. That is not how it used to work. And that's a symptom of a problem with the currency. If you look at home prices in Bitcoin have collapsed over the last 5 years, over the last 10 years. Home prices in gold have fallen sharply over the last 5 years, 10 years. And so I think the solution for a young person wanting to own a home at some point is to be as disciplined as you can and save in some blend of gold, Bitcoin, and some stocks every month, and ultimately save in a better currency than dollars. And that should, in time, drive home prices down for you in your savings vehicle, as opposed to what we've been seeing, which is a symptom, again, of a problematic currency with home prices going up, with yields going up. And the final question from Tom: the Bank of England halted delivery of gold to New York today. I'm not sure they halted it, but they definitely have dragged out deliveries. 4 to 8 weeks is what I saw, when it's normally a few days. What is the probability and consequences if gold delivery times don't accelerate? I think you ultimately, price solves everything, right? You'll see higher prices. To me, it is really interesting why this is happening. It's not like it's a surprise that Trump wants to do tariffs. I'm a little surprised that a Basel Tier 1 asset like gold would not be exempt from tariffs, or could not be if this isn't what the U.S. wanted. So it's a little curious to me, but ultimately, one way or another, the gold will flow. Price will ensure that. So, with that, I'm going to finish up for the night. As always, thank you for joining me. And if you like these updates, please check out FFTT-LLC.com for more information about our Tree Rings product. 10 most interesting things. Brief synopsis on what grabbed us about each, and whether it's either reinforcing or changing a way we'd previously been thinking about the world. So with that, I am going to sign off for tonight. Thank you for joining me, and I look forward to chatting with you soon. Take care, everybody.